The Middle East conflict is already moving global markets. Oil just pushed to around $90 a barrel, and that move is not just another price fluctuation. In markets, oil is often the first place where geopolitical risk appears. When tensions rise in the Middle East, the energy market reacts before most other assets do, because traders start pricing the possibility of supply disruption. That is why this level matters. Right now, the next levels the market is watching are $95, and above that, the psychological $100 mark. If oil starts pushing toward those zones, markets will begin to price a longer and more serious geopolitical risk premium. And when energy moves like that, it rarely stays isolated. It starts a chain reaction across the financial system. That is why the next chart worth watching is gold. Historically, when geopolitical uncertainty increases, capital tends to move towards safe haven assets. Gold has already been showing that behavior. Structurally, it remains in a clear upward trend, holding above the 5,100 area, which acts as an important support zone. As long as gold holds that structure, the next area traders will watch is around 5,600. The reason gold matters in this context is simple. It tells us how much fear is entering the market. When investors begin shifting capital into gold, it usually signals that they are preparing for uncertainty rather than chasing risk. But the most important chart in this entire macro picture is not oil or gold. It is the 10-year US Treasury yield. This chart tells us the price of money in the global economy. When yields move higher, borrowing becomes more expensive, financial conditions tighten, and risk assets begin to feel pressure. Right now, the yield has rebounded from the 3.95% area and is sitting around 4.1%. The level the market is closely watching is roughly 4.3%. If yields break above that level, it could signal that markets are starting to price higher inflation and the possibility that interest rates stay elevated longer than expected. That is where geopolitics and macroeconomics meet. From there we move to the stock market, specifically the Nasdaq. Technology stocks are extremely sensitive to interest rates, because their valuations are heavily dependent on cheap capital. At the moment, the Nasdaq is trading inside a range, with resistance near 26,188 and support around 23,993. In other words, the market is waiting. If energy prices continue to rise and bond yields follow, that pressure can begin to push technology stocks toward the lower end of that range. And then there is Bitcoin, which often acts as a gauge of risk appetite. Recently, Bitcoin broke below the 71,000 level, a key support area, and is now testing the market's confidence. The next support traders are watching sits near 64,000, and below that the major structure appears closer to 52,000. If geopolitical tension increases and liquidity tightens, speculative assets like crypto can sometimes feel that pressure first. When you step back and look at these charts together, a pattern begins to appear. War risk moves energy. Energy influences inflation expectations. Inflation pushes bond yields. Bond yields affect stocks and risk assets. This is the macro chain reaction that connects geopolitics with global markets. This is also where the philosophy often discussed by Robert Kiyosaki comes into play. The most important question in markets is not simply what is happening in the world. The real question is where money is flowing. When uncertainty rises, capital searches for protection. When liquidity tightens, risk assets react. Understanding those flows is often more important than the headlines themselves. So the real question becomes this: do you already have a clear strategy and structure for reading these movements in the market? Or are you still trying to understand how these pieces connect?